Hey, welcome back to the Sustainiacs, everybody. I am Mike Vincent, and my guest today is R. Paul Herman of, is it HIP Investors? Because I like to say hip investors, because you're a pretty hip dude.
We are hip and we live the brand, and nobody forgets
Right.
hip and investor next to each other.
I love it. He is a hip investor, man. He only invests in hipness, or rates the hipness of investments, I guess is what it is, right? It's
Correct.
the
Both
Herman Impact. Uh, uh, what's the
human
P?
impact and profit. Human impact.
Human impact and profit. That's what it is. That's what it's not. Herman impact and profit. That would make no sense whatsoever. Human impact and profit. Do you just go by R, or do you go by Paul, or do you go by Paul?
I go by Paul. I go by RPH. I go by RPH. I go by Rumpelstiltskin.
Oh, okay. That's fantastic. I love it. And you were saying, I said, do you go by R, or I mean, do I introduce you as R. Paul Herman, or just because you have to differentiate yourself on different media for people to find you, right? And
Yeah, our Paul Herman is good. That connects to our books that Wiley published. It pops
yeah,
up on LinkedIn. So, and we have 19 years of writing things, so it'll pop up.
yeah. Well, I mean, you said Paul Herman's also a guitar player that comes up.
Then there is a Paul Herman guitar player in the UK that if you just put in Paul Herman, he has more images than I do with his guitars that you love. So Michael, so
Yeah, that's interesting. Uh, David Bowie got his name that way, right? I mean, not from Paul Herman, but there was another artist that people thought they were going to see when he used his name Davy Jones, if you remember. If you remember Davy Jones,
I remember.
and they certainly didn't find Davy Jones when they went to see him.
Well,
Anyways, let's get into this, brother. HIP. Is it? Do you go by? Is it? It's HIP investment. I mean, that's what it says, or hip
yeah,
investment.
it's hip investing. It's how
Yeah,
hip is something. Is something hip and more sustainable, or is it unhip and is it more extractive?
yeah, exactly. Right. I mean, that's what I kind of figured there. It's a great name. So, but tell what do you guys do? I mean, obviously, right there, anybody who has any information or idea about investing understands probably what you do. But please explain what hip investment is for the people.
Sure. Well, essentially, to be hip is to do good and make money at the same time. And some people might say, "Oh, that's impossible. How do you do that?" But basically, if you treat people right and you don't, pollute the environment and you don't get sued, you're pretty much on your way to being a good company and a good investment. Because great people invent new products. Those new products sometimes are patented. That means you have a higher revenue stream and a higher profit stream and higher margins. If you don't pollute the environment, the water, the air, that means you won't get sued and you don't have to clean it up later. And if you do right and act in a balanced way, then people won't sue you. You don't need to lobby. You can essentially stand on your own 2 feet. And of course, all of that includes like having a diverse team of talented people who are men and women, who are racially diverse and the like. So when companies exhibit those characteristics, they get a higher hip rating. It's based on data, real data about the real world. And when they do, they typically have higher shareholder returns over long periods of time. So higher hip rating means higher shareholder return in general over time.
So you're trying to convince us that ESG actually will help you make money.
ESG can help you make money, and ESG can help you reduce risk and future risk too.
I absolutely love it. And when you talk, just a real quick question, because I mean, this is what we're doing. We're going down rabbit holes, but what you spoke about the ESG quite clearly, and you talked about diversity of the people. Does economic background and their growth background matter in that as well? Shouldn't that be something that we should think about as well? I mean, I get racial, right? Because you talk about that, but racial more and more doesn't really mean that you came from a more affluent or less affluent background, right? But that would be an important part of your team, wouldn't it, to get the different aspects?
Yeah, so we look at a whole range of real data about the real world.
Yeah.
And that includes employee pay, like you're referring to, and
Yeah.
the average employee pay, the employee pay by gender or by race where it's available. Because today, some of you in the sustainability community may know that there's a form called the EEO1, the Equal Opportunity
Sure.
Commission, mandates that.
Mhm.
Historically, that's been a private document, but
Okay.
increasingly in the past 5 years, it's become more and more public. And so that disclosure of how diverse are you at the different levels of organization, plus what you get paid, you can start to see that even if despite whatever upbringing you have, you can see if there's tilts in that or biases or racism or genderism. So more and more, when you have real data about the real world, those drivers of diversity. So the North Carolina State professor, this is from 2018 already now, has shown that diverse teams create more and better products that then have more patents, that have more revenue, and then more profit.
Yeah, but
So
they have to be managed correctly, right? I mean,
sure.
the end goal can't be the diversity. It's got to be the benefits from that diversity, right? Does
Well,
that
one
make
of the
sense?
packages is the diversity itself, because
Okay.
if you never permit it in, then how
Yeah.
do you achieve it?
Well, yeah, okay, that makes 100%. If you keep it away, if you actively don't permit it in or don't actively search for it, but what I'm saying is the qualifications for that job and the the intelligence of that particular person, regardless of the diversity, to perform and to interact with the culture of that team, it has to be part of that as well, right? For it to be impactful in
It's
a
all
revenue.
about, to simplify it, it's all about return on investment. So
Yeah,
if
yeah,
you
yeah,
make
yeah.
an
It
investment
100% is
if you
right.
make an
Yeah.
investment in a good person and you train them and you have a good management style, because bad management will drive good people away. So, and there's this historical, sort of a cliche of grade A players want to hire grade A players. Like they
Yes.
want to
Yes.
keep maintaining and upping the average. And the question is, what do grade B and grade C people hire? And sometimes they don't want to hire people better themselves because they'll make them look worse. And so that's the challenge in any organization, is how do you keep upping the average of the talent? And everybody has different skills. So sure, somebody might be better at you at some things, but everybody has a unique way to add value. So one of my old mentors, Leo, told me one day when I became a manager, he was like, your job as a manager is to figure out what people do great and let them, unleash them. And that's not easy. It's not easy to do, but great companies do that. And great companies to work for end up having lower turnover, not higher turnover. One of the worst companies for turnover is the dollar store. So at the dollar store, the annual employee turnover, the rate at which people leave, is 400%.
Well,
That means the
wow.
average employee stays there 3 months. So you
That's
can't,
worse. I mean, that's worse than trucking, which is pretty high.
yeah, you can't run a great company when people are leaving every 3 months on average. You want a company where talented people stay a long time. And
Yeah.
just like the elite sports teams, you need the team to be together to predict to know how you're going to act and to predict how they likely will act. And when that happens, these great places to work for end up as a group. Like we have an investment strategy at HIP, the Great Place to Work strategy, that's made 15% a year for more than a decade on average. So these factors work when applied in a capturing real data about the real world.
That's amazing. That's amazing. So you're rating companies for investment, for investors,
Correct.
right?
Correct.
Okay. So who are those investors that you're rating them for? Am I a private angel guy and I'm going to your website and going, okay, look, I'm looking for investments into good companies and I'm going to get some sort of list from you and rating that's going to say, yeah, this is cool? Or are companies just publishing their hip rating, right? Their hipness when they send out their seed round raises, et cetera, or what's going on? How does it work?
Yeah, so we rate public stocks, so stocks you can buy on Schwab
Hmm.
or
Okay,
Fidelity, right?
I got you.
We rate muni bonds, and so if you're buying a city bond or a hospital bond or a school bond, we rate those. We rate private companies when asked. Private companies don't usually share data openly, so that's a little bit more of a custom approach.
I got you.
We rate private bonds, private credit. So, and we do that for everyday investors. We do that for high net worth investors. We do it for foundations, like the Sierra Club Foundation is one of our clients. We manage their real estate investment trust portfolio, for example. And then we license our ratings to big companies. So companies like Bank of New York license our ratings so that they can apply that in their business. So we work with individuals, with families, foundations. And then some investment advisors say, hey, you do the investing for me and I'll serve the clients. So we work with investment advisors and wealth managers as well.
Oh wow. Okay, that's fantastic. So how do you go about doing these ratings? Where do you glean all this information from the companies in order to say they're this or that?
Yeah, so it comes from a variety of places. So the company itself will publish things.
Sure.
And so, we're in the Sustainiacs community. So greenhouse gas emissions, many of us know what those are.
Sure.
That was not really published, more than 25 years ago. So one group who sparked that is the Climate Disclosure Project, CDP.
Sure.
And at CDP, when they started a quarter century ago, um, there were only a couple hundred companies who did it. And they got companies like Shell Oil to do it as well. And Shell Oil, they're in the fossil fuel business, but they've been doing scenario planning over the past quarter century. And so if something is too environmentally insensitive, they'll probably change how the project operates or even kill it. Today, there's more than 10,000 reporters to CDP. So one of our inputs is the greenhouse gas emissions and the water intensities and the energy intensities and the waste treatment of thousands of companies. And those are all opportunities to reduce cost, reduce risk, and to show that you're a more efficient company. So, like if you're putting gas in your car, you want a higher miles per gallon for what goes in your car. And you want that for two
Sure.
reasons. One, you use less gas, but then when gas prices spike, you're not exposed to that spike if you use less. So it's the same thing with companies. Companies who use less energy are not only consuming less and paying less, but they're less susceptible to those price spikes. And water is going to be one of those areas that is going to have some price spikes in the future, coming in the
Yeah.
future, because the water scarcity and water quality, and now the proliferation of microplastics. How do you know what quality water you're going to get? And if you run a manufacturing business, you can't have microplastics in the water to in your manufacturing process, let alone in your consumer products of bottled water. So these are real data about the real world, quantitative, and then we compare them to things like evidence-based targets and science-based targets. And a science-based target is something like Unilever, if they will continue doing this, has committed to 100% greenhouse gas reduction by the year 2030. And now they'll probably won't. They probably won't eliminate 100% because they're going to probably use carbon credits, but they're going to seek to dramatically reduce what they're doing. And so we're comparing, before and after. What's their target? Are they making progress? Are they falling behind? And it turns out there's three groups today. There's a group of companies that have an aggressive target and they're beating it by double. So they say they're going to reduce 4% a year and they're reducing 8% a year. So there's about a third of the company.
But you've got to look at that and weight that, because that's an interesting thing, because you see where I see reports and the headlines are clickbait or they're false narratives, right? Which really bugs me because, you got to understand the audience to which you're writing and to which you're presenting facts to, right? And a vast majority of the people are, without offending everyone, they love headline porn, That's it. They very rarely understand the details behind it. And when you write a headline that is technically true, it produces these mass opinions that are false. Like, this company has completely, like, Old Dominion got rid of all of their sustainability goals. 100% false. They adjusted many of them and refused to add some to them because they're already hitting these goals, and they're not going to purposely put themselves out there with a goal and then miss it and then be considered a failure when getting 90% of that goal is actually a massive success, right? And that's kind of what I'm talking to here. You got companies that are hitting 400% of their goal, right? But if that goal is, 5% of what somebody else hit and they hit 90% of their goal, not so impressive, right? But
Right.
still the right thing and should not be discredited.
Yeah, so this is a perfect.
It's a difficult thing, right? It's not perfect, right?
Yeah, that's a good deep insight, Michael. And so what we test, for example, in this area of science-based targets is how aggressive is your goal? 100% by 2030, very aggressive.
Yeah.
What are you actually doing? What is the actual greenhouse gas reduction in tons relative to what you're reducing, and in the absolute? Are you ahead or behind of that goal? What is the relationship to your revenue? So is this a meaningful part of your revenue or not? And so these types of metrics, we're twisting the Rubik's cube so that we can see all the different ways. And you might do well on one and terrible on six. And so what we're looking for is who's doing as good as possible on all of these metrics at the same time. And companies are, big enterprises, and they can't do everything great at the same time. But what we're looking for is who's doing more sustainability across more factors that are material to profit and shareholder value and risk reduction. And that's why nobody gets 100 on our scale of 100. People don't even get a 90 as a public equity. So some of the highest scores on this 0 to 100 scale of what's doable and possible is usually in the 70s or the 60s on a scale of 100. And the unfortunate reality is most public companies rate below 50, which we would call net negative. And so they're more extractive than sustainable. And
okay, so is that what it is? The 50% mark is your extractive, or
yeah, we have two
scales.
We have two scales. One is the absolute scale. One is the 0 to 1 absolute scale. So 50 and above is net positive. 49 and below is net negative. So that's one scale. Then there's the relative scale, which is, okay, for your geography, industry, what is the relative score? And so then what is your relative strength compared to others in the logistics business, in the airlines business, in the electric utility business? So on the absolute, because what we found early on, another lesson of psychology and investor psychology and human psychology is, if your investment rate's a 60 out of 100, if that was in school, you'd get an F.
But, of course.
But on a relative basis, they're like the top decile.
Sometimes you got to get graded on a curve, buddy.
Right. So we have both a curve and an absolute, because there's so much sustainability potential across public equities, muni bonds, private equity, venture capital. There's a lot of work all of us need to do. So it's exciting to be in the Sustainiacs community, to be like, okay, how do we all take action at the same time and get there?
Yeah, and that's what people need to understand. But see, what you're doing is really interests me. When we were introduced and I got to understand what you're doing is exactly what, in my opinion, needs to happen, right? Because people see, well, ESG is a scam, or it's an intelligence suck, or it's a capital suck, and all this other kind of stuff. And that's not what it is. If done correctly, if it's done for the wrong motivations, I can see where that can happen, right?
Correct.
It's just like capitalism. If you're extracting wealth, that's not good capitalism, right? It's not beneficial. It's not virtuous capitalism. It's not conscious capitalism, as Stuart Hart would say, right?
Right.
it is the idea is to produce wealth, right, and to produce it in more than just monetary terms.
Well, yeah, and we would say the purpose of capitalism is to produce five things. It's to produce health and wealth and support the earth and equality and trust. And all of that was based off of Maslow's hierarchy of needs. So, like, I took a look at Maslow's hierarchy of needs, said, okay, well, this makes sense. What do people need? People need to be physically and mentally healthy. So, like, today, there's a big, pushback on health insurance. When companies like United Healthcare deny a third of claims, that system is not working.
I think they were the model for the opening scenes of The Incredibles.
So people need physical health and mental health. And there's just a beginning discussion now about mental health with, organizations like The Real, of people addressing mental health in their, everyday life and business. Then there's wealth, which is we all need income and asset building as employees. And the tech industry has done a lot of that with stock options for employees. And so there's, Microsoft millionaires and Facebook millionaires and the like, but that doesn't happen across most of business. So
no, it certainly does not.
And you used to get a pension, but you don't even get that. So you have a 401k, you might have 401k matching. So we look at that. Then to operate, you go home to your family, you want to take a dip in your pool, you want to go to the lake, you want to run outside. You need clean air and clean water. You can't have the lake burning like in Cleveland in the 1970s. You need an environment. And then everybody needs an opportunity. So that's what we call equality. It's under pressure again today with the anti-DEI movement. But, we all come from our mothers. Would we tell our mothers that we'd, be biased against women? No, she'd smack us in the face.
Of course.
So equal opportunity is one. And then trust. And so the highest Maslow hierarchy level is self-actualization. But that requires like confidence in yourself, trust in yourself. And in economy and in a society, that means like trust in each other. And how do we achieve that trust in each other? But if we're sick and we're not making enough money and the air sucks and our friends who are diverse are not getting opportunity, we're not going to have trust. So these five, we call them pillars: health, wealth, earth, equality, and trust. They map to ESG today, and they're data driven about the real world, and the organizations who make quantitative progress in these ways across 32 metrics in a business, you get a higher rating if you do better, because you're making better people make better employees make better products, and better products make better profits. So it's intuitive if we want to pursue it.
Yeah, no, it absolutely is. And I would argue, we're not arguing at all. We're discussing, because I think we're both on the exact same page on most everything that we're discussing. And one of those is, in the basic premise is, in my mind, the drive towards all the points that you're talking about, when managed correctly, is business 101.
It is.
In my opinion. These are unfortunately semi or kind of foreign or thoughts or alien type of thoughts to certain people. But I think that's because they've veered away from just the basic knowledge of how to run an actual business, right? I mean, these employee diversity to get the best possible inputs. I don't know where it first got. I mean, it was racial at first, right? But then you still have pockets where it's not racial, but it's just a bunch of yes people, right?
That's what happened at Boeing. I mean, the tragedy of Boeing is, making airplanes, which was once described, somebody came over from Boeing to Ford. So one of the, ex-General Electric EVPs who worked for Jack Welch at General Electric went to Boeing and then came over to Ford. And he went into an engineering meeting at Ford, and they were talking about some technical issue. And they said, how many parts in a car? 30,000 parts in a car. He said, well, at Boeing, we had 3 million parts, and we had to keep the plane in the air all the time. So this complexity of product complexity and engineering complexity and safety and quality, for the most part, flying in a plane is one of the safest things you can do typically. And when Boeing later, acquired McDonnell Douglas, and then the financial engineers took over from the product engineers, and later the headquarters moved from Seattle to Chicago, and later the labor union work that happened in Seattle moved to South Carolina, all these problems kept multiplying. And that was because people were managing to the financials instead of managing to the product and managing to the quality aspects. And quality, people want quality. They usually want it at a decent price, but we don't want a cheap plane that falls out of the sky. We want a high quality plane that's affordable. And so the more you make quality, the more people demand it, and that gives you a bigger business to scale the cost structure over, and then you can make your pricing decisions about whether that's luxury pricing or cheap pricing. And this is happening in luxury goods today. So I went into the store the other day, and I'm like, oh, a sale. Let's check out what this luxury good is on sale. It was terrible. The pocket fell off. There's no
Oh boy.
inside liners on jackets anymore. I complained to them, and I walked out of the store. This decline for cost reduction at all costs is costing us our livelihoods. So what human impact and profit is about is hire the best people, make the best products. Those will typically sell. You get higher revenues, higher profits, and more stability over time. And do that not just for your business, but do that for your society and nature, and things will stay in balance. And so that's what we're trying to reinforce with this quantitative way of evaluating investments is when things are in balance, they tend to survive. When things are out of balance, they're extractive and they don't last forever, or they cause other problems that we need to go fix, like climate change and racism and things like that.
Yeah, yeah. So what is, excuse me, what is the force that you're fighting against, so to speak, or what is the, because unfortunately, and I'm sure you agree, this is a bit of a novel idea, but it's also a retro idea, right? I mean, this is originally what we looked at businesses to do, right? I mean, you couldn't just incorporate in the United States to gain a profit. You had to prove more before you could be a corporation. back in the day when there was still virtue to the incorporation or the company or to capitalism, you had to prove a positive impact on the society in some way. So what's the norm that you're against? Is it I always argue, our society, the issue is the financial system and how it's been bastardized into just wealth creation just for the sake of wealth creation. That's not good enough. That doesn't work, right? So are you the lone beacon out there? Are you fighting a tidal wave?
Well,
What's
I'm
the
not the lone
battleground?
beacon. I mean, you have
Yeah.
tens of thousands of people who, engage in Sustainiacs. So all the Sustainiacs community is a beacon. And there are good people every day who are trying to do a good job that are sometimes repressed by, these management systems or financial focus that you're talking about, Michael. So I'd say factors that are part of the tsunami to fight are that impact and profit aren't against each other, that actually higher impact can lead to higher profit. So
Right.
that's why we put it in the name. Human impact
Amen.
plus profit, not human impact versus profit, not human impact is less than profit. So that's one is like the cost of labor. So we've all heard CEOs say people are our most important asset. Most times people are not treated as the most important asset. And one of the reasons is people are not an asset on the balance sheet financially. People are a cost on the income statement. They're not an asset on the balance sheet. So we're not talking
Mm.
about owning people. We're not talking about slavery, but we are talking about, we talked about Boeing, FedEx. Those companies have basically a long-term operating lease on the productive capacity of that asset. That's what happens when we go to work. Your employment is a lease on your time to go add value at the company. So that's an actual asset that could be on the balance sheet. It is for leasing companies, so it could be for everyday companies. Um, Another force is short term versus long term. And so we did 10 years of work with asyousow.org every year for 10 years, looking at overpaid CEOs.
Okay.
And it turns out that companies with overpaid CEOs financially underperform. And some of those, like Disney and Warner Brothers Discovery, underperform for 10 years. They have 10 years of overpay and 10 years of financial underperformance. Because when you overpay a CEO, you basically rip the heart out of the workforce. You're like, why do they get to make so much money? We're doing the work. Why are they capturing that? And one of the problems with CEO pay is, there's bundles of stock options and stock grants and the like. But one of the problems is that, when you buy a house or you buy a company, money goes into escrow. And that's what should happen with CEO pay. Like, if a CEO does a great job of making the company more worthwhile, like Paul O'Neill did with Alcoa Aluminum, he, over 10 years, focused on employee safety. And he almost got fired by the board because they're like, what are you talking about, employee safety? We want to make money. He was like, the only way we make money is if people don't get hurt and don't die on the job. And it worked. He 10x'd the market value of Alcoa over 10 years. And that's what we're talking about with human impact and profit when you focus on health, wealth, earth equality, trust. So this short term versus long term. So CEOs are able to make short term profits and cash out, even though what they built may collapse. And so the job of a CEO isn't just to lead the company, it's to pick the next wave of successors. It's to reduce future risk. It's to make sure the R&D and product roadmaps are full of great products. And Jeff Bezos, can be critiqued in many ways. But one of the things he would say when Amazon would deliver a good quarter is, yeah, that quarter was baked three years ago. Like, we put that plan in place 3 years ago. And so this long-term thinking of how do we build something over years, not quarters, over decades. Family-owned companies do this great. Family companies think, Cargill is a big family company. They're thinking over 100-year cycle because they want their inheritors to inherit a good company. We've lost that in public companies sometimes. And so there's a distinction between founder-run companies and non-founder-run companies, for example. So there's short-term versus long-term, impact versus profit, and then just like being genuine, like genuinely being in balance versus imbalance. Those are some of the both biology and psychology factors, sociology factors.
Yeah, so you look at the investments of the company as well as kind of part of what I'm getting out of this as well, right? I mean, the growth of the company and their strategy and growth is a huge part of what you're talking about, if not the entire thing, right? I mean, their strategy for growth is how they're running their business, but like the vast majority of public company growth or stock growth is done not through product and not through innovation; it's through buying back their own stock.
Yeah, that's another problem.
It's like 80% of the growth in stock prices is due to the company buying back their own stuff to elevate so they get a golden parachute type.
Yeah,
right?
and As You Sow, the nonprofit, has looked at that too, of what's the proportion of share buybacks, which have lower taxes. So the reason companies do that is it's a low tax way, versus dividends, which have higher taxes, versus R&D, which is, hey, we should put this money back in the company.
Yeah, and actually grow something sustainable.
Exactly. And so there's not enough R&D. So you'd ask for like, what are fundamental things? Like, look at what the R&D rate is. And that may mean, you mentioned like private companies and venture-backed companies. Venture-backed companies don't pay dividends, except to some of the investors on a preferred stock. They put the money back in. And so they're trying to grow and scale the company. That is missing from many of the public company investments today. So a really important data-driven metric is, what is the R&D percentage and what types of products are being. So we talked about like how Boeing was mismanaged, but like, what are companies that are well managed? Like Schneider Electric is one. And
yeah, that's true.
And Brambles is one. And these are names that are not household names yet, But what do they do? When you look at, if you were to go to their website at Schneider Electric or Brambles, what you will see is here's what's going on in the world. Here are the fundamental forces we're trying to shape in the world. And here's our business in relationship to that. And here's how we're trying to make the world better through our business. That's not how most annual reports are written. Most annual reports are written of like, here's our product, we're going to sell as much as possible. And so that relationship to the whole versus, you as an individual versus you as an individual as part of a whole, that's another like philosophical element of what we're doing. So, and so there's a handful of companies. So we've written, 2 books, the Hip Investor book that was published by Wiley. It's now the 15-year anniversary of that book. And the Global Handbook of Impact Investing, also published by Wiley. That's 50 authors and 30 chapters. And so it shows the depth and the richness of analyzing investments in this way, that prioritizing people and the planet and trust are leading indicators of future profit, future revenue, and future shareholder benefit. So that's what we do with our ratings, and that's what we do with our investment portfolio's that we manage for clients.
So how does you mentioned before, we were talking about how a company is, and you mentioned Unilever trying to go total GHG 100% just carbon neutral or negative by 2030 or 2036? 2030 by 2030. And you said, you mentioned, measuring actual, which would imply that carbon credits don't cut the mustard for you.
They do not. Right? They do not. I mean, it's like once the exhaust comes out of the back of your car, how are you going to capture that? Because those carbon molecules live for 100 years. Every carbon molecule out of your exhaust of your scooter or your car lasts for 100 years, and then they accumulate, and then they overwhelm us.
They absolutely do. But carbon credits, I mean, I understand, but the idea of carbon credits, is it because it's been bastardized from its original intent? Or was the original intent already wrong in the beginning? I don't know which came first in carbon.
I don't know if it was.
I get the idea of it on the virtuous side, right? Yeah. It's if you can't change anything, you're at least funding somebody who can, right? Until you can figure it out. I mean, that's kind of the idea in very base form, right?
I'll explain it this way, Michael. I worked in nonprofits for a while. I worked for this organization called Ashoka, ASHOKA.org. We funded social entrepreneurs and environmental entrepreneurs who were nonprofits around the world. And one day I just sat back and I said, okay, if we funded all of these social entrepreneurs, what is the total amount of charity dollars in the world? And in the US, it's somewhere between 300 and 400 billion per year that people donate to charity, mostly to churches, but also to, nonprofits that solve environmental and social problems. And then you look around the world, and not every country has charitable donations because you don't get tax benefits. So I just rounded that up to about $1 trillion. The global capital markets are $200 to $300 trillion. And that's my sort of metaphor for carbon credits, is just as charity is $1 trillion versus 200, 300 trillion of capital markets, so are carbon credits to the overall carbon emissions. And so we really need to address it at the source. Are carbon credits good? Yes. Have some of them been bastardized? Yes. Did Congo, the Republic of Congo, just absorb all the carbon credit, that were set up there and did like a government takeover? Yes. Is there a problem with double counting, triple counting? Yes. But even at scale, we're trying to clean up afterwards. And it's like, after the bathtub overflows, how big a mop do you need? And I say, let's just cut off the faucet and let's reduce the faucet and let's get, efficient shower head for your shower, or figure out the right way to create value physically. But don't try and buy a lot of mops with a lot of absorption capacity. Fix it at the source. So that's our approach. And that's where we need the innovation, because companies are going to continue to grow. One of the problems in the science-based target, so there's today, there's 1,000 plus companies with science-based targets for greenhouse gas reduction. At least 754 of them are public equities. Of those 754 with public equities, we classified their progress into three categories: companies who are ahead, usually by double, companies who are reducing but behind their target, and then companies who are going the other way. And so there are many companies going the other way of a greenhouse gas reduction target, but adding, and some of those are AI data centers as part of tech companies. Some
Yeah,
of those
yeah.
are growth in the company. So even those who are illuminated enough to have science-based targets, which you can find on sciencebasedtargetsinitiative.org, even those aren't doing their job yet. And that's only 754 public equities out of 14,000 that we track around the world. So it's a small proportion that is not all succeeding. And so we need to get these other 13,000 on board to do some form of environmental efficiency so that we can have a good quality of life. And so it's all integrated. So as much as possible at the source in a meaningful way. And when you do that, when you reduce energy, you reduce greenhouse gas emissions, you reduce cost, and you reduce the risk of future price increases. So it makes business sense.
It makes 100% business sense, and your argument is solid in my mind. Not that you need my, stamp of approval on it, but it is. But let me ask you this. So let me put forth this for this argument. If you're, say, and I'll just use the industry I'm most familiar with in trucking, right? And you own a fleet, okay, and you're a public company. Should there be credit towards investing in nascent technologies that have the promise of reducing that GHG,
Conceptually,
or
yes.
in other things, right?
Yeah,
And with
conceptually,
that,
yes.
so I mean, if you took the concept of the carbon credit, right, but you fixed it. There's a guy, I don't know if you're familiar with Chris Draper, but he was on the show. He's in the Sustainiac, so Chris Draper, he runs a company called ESG RAC, ESG space RAC, and he's developing these. They're called HUs, or human units, right?
Okay, I like it.
that
I like it.
right that are very much they're credits. They're like a carbon credit, right? But he's trying to design it so that misuse of them, that double accounting, et cetera, is gone, is taken out of it, right? But it expands things past just reduction of carbon, right? So if your business is one that helps the S in ESG, right, or the G in ESG, or any of these other things that we're looking at, there is a form of there's a way in order to facilitate more investment in that nascent technology through credits, right? So, you're in a company that can't necessarily impact credit, like a retail store, for instance, right? I mean, you've got your LED light bulbs and so on and so forth, and heating, where you get your energy in that. But beyond that, unless you're utilizing specific carriers and stuff like that, but you can only use those that are out there. Investment in things that you can't impact through redesign of your governance or your manufacturing, that type of financial system, in order to target that smaller nut that you're talking about, that less impactful, which I agree with 100%, but it shouldn't be discounted completely, and maybe there's ways to hit that. Does that make sense?
Yeah, that totally makes sense. And I'm sorry I don't know more about Chris Draper.
No, I
And
put
his
that out there
human
because
units.
very
No,
few
no.
people do,
Yeah,
and I'd
because
love for you
that
to
human,
look him up a little bit. Yeah.
because for those of you listening, if you look up Chris Draper and human unit, you'll see like a periodic table unit called human.
You will, yeah.
Unit.
No. He was totally a chemist. So
Yeah,
he's
no,
got,
it's
yeah.
because that periodic table of elements, the human unit, the water unit, the air unit,
Yes.
the trust unit, like that periodic table of thinking. It's interesting that you mentioned like industrial and logistics. It turns out like our highest rated companies are not tech companies in the HIP ratings.
Oh, really?
The highest rated companies tend to be industrial companies because
Oh, wow.
they're run by engineers, and engineers
Ah.
think in a quantitative, systematic way. And so engineers, including like Intuit's one that is like part software, part financial, like they survey all their employees every November. It has 95%. 95% employees complete the employee surveys, and what they get is the supervisors get rated by their teams, and when a supervisor gets a low rating, then HR swoops in as like, why are your employees not rating you highly? What's going on here? And so you mentioned earlier, Michael, in the conversation about, is it management style? Yeah, totally. You need
Can be, sure.
supervisors, which people don't get trained how to do. You need great managers. You need people who aren't controlling usually. You need people who are empowering. So on the human unit and on, like logistics, who's one of the biggest innovators in those solutions you're alluding to in logistics? Walmart, because Walmart has a fleet. So when did the wind, not the windshield of the glass, when did the wind shaping above the cabin of the truck come in? It came in early because it saves gasoline.
Yeah, and the skirts, the side
and you have the skirts under the trailer, because then that restricts the air from going under. So now you have, whether you have a flat truck cabin or you have an engine-driven cabin, so now you've shaped it like a bird in a wind tunnel.
Yeah, it turns out a big rectangle going down the road isn't the most efficient way.
Exactly.
Very strange.
Exactly. And then you have like the electric power. And so instead of running the diesel all night at the truck stop, now you have electric power and electric batteries plugged in. And so
and solar now, there's a company that's doing solar that is fantastic. It's actually better than the battery in the diesel run. It's
right.
Fantastic.
And so depending on there's the trucking industry and there's a real estate industry, and they may have similar like economic dynamics. So if that trucker owns their own truck, the question is, are they going to do something that saves them money? Yeah, they probably are.
100% they are, yeah.
Benefit from it. Now, do they have the capital to do that? How do they access the capital to do that? So that's an issue as to how to resolve that. If there's a fleet of trucks and it's owned by somebody who only thinks about short-term profit, are they going to make those improvements? Are they going to say, oh, I'll just pass on the gas cost to my customer? Like it's a pass-through rather than profit. So the pricing model matters. Is the pricing model a pass-through, or is the pricing model some sort of fixed unit? And when it's a fixed unit, then cost reductions matter. Same thing happens in real estate. You have, for those of you who are Sustainiacs, who deal with real estate, you have like triple net lease sometimes. And depending on how those leases are structured, the benefits of energy savings and energy improvement, if you're leasing and don't own, you're probably not going to make those investments. And the landlord's not going to make those investments because they're not going to get the benefits from it. So you've created this, in economic technical terms, separation of agency. And so the more we can push the economic benefit to those who have the economic control, who have the operating control, the more likely you are to do this. And you mentioned like innovation before. It was the case historically at Dell Computer. Whenever a business unit went over $1 billion revenue, they would break it up. And the reason they break it up is so that it maintained that small company growth culture. And so that's another like management system and management approaches. Don't let things get too big. So like,
yeah, I was going to ask, is maturity of the industry and or business a detriment to what you're measuring? And it would appear that it would be, right?
It could be. It could be. What we found is, like I mentioned, how engineer-run companies tend to get higher HIP scores. They quantify things, they track things, they want things to be more efficient. Another contributor to a higher HIP score is the cycle of innovation in that industry. So consumer products always need to be innovating, but utilities historically haven't innovated. And so that speed of innovation of consumer products tended to want the most diverse teams, to have the maximum ideas, to create the biggest variety of products, to generate the patents, to generate the revenue, to generate the profits. Utilities, they're a monopoly. Like you buy it and it's a cost plus business. Now that has changed since deregulation and 1980s, which was part of my first job at McKinsey in the energy practice of, overseeing some of that deregulation, incentive regulation. Like some of the concepts of what we do today came from that incentive regulation, which was do things that are positive return on investment, not cost plus, but like efficient. And and in incentive regulation for utilities is around things like keep the power on. Like if the power isn't on,
Yeah. That's
right?
it.
And another one would be don't pollute. If you pollute, we're going to knock down your return on equity as a utility. So that like balanced impact and profit. And really if you delivered the maximum impact, you could achieve the maximum profit. And that's the dynamic that's missing. So cycle of innovation, age of workforce. So the right blend of young to old in the workforce is another factor. That was kind of a surprise to us. And then this like engineering mentality versus non-engineering mentality. And then things like, are you product driven or finance driven? Are you short-term oriented or long-term oriented? So these start at the top, and that's why founder-driven enterprises that grow usually have some element of this. And then at some point it flips, and then you bring in external management. Sometimes you bring in private equity. They want to extract dividends from a growth company when they need to have more R&D. So there's a whole bunch of factors that can be at play.
Yeah, I mean, my experience and when I talk to others would lend to you would think that VCs and PEs would cease to exist. Not all of them. Okay, I've certainly have, but you can certainly speak to just about anybody in business who's dealt, and they'll have a horror story of some sort.
Yeah, unless they have experience in the business, it's really difficult to come in as a financial expert without operating experience. So the well-run VCs and the well-run PEs either have like an industry.
There are excellent ones out there.
Yeah.
What I'm saying is, as a business owner or an entrepreneur or a company that's growing, just getting that check written from a PE or VC is not the goal. It's got to be a solid partner.
It does have to be a solid partner because so many things can go wrong. Like that 5-year capital might need to be 8-year capital. So that causes some squeezes, right? Or there's a difference between short-term profit and long-term profit. So that might be a
big difference. Yes.
Some of these get ready to like get sold to a public company. So they'll do a lot of squeezing in the last quarter or two to pretty it up for a public company acquisition. That happens.
To pretty it up. Yeah, see, that's one of the biggest things. You're putting lipstick on a pig and then selling it is one of the things that really bugs me about it. But yeah.
Yeah. So it's really the trust in the partner, and it's the flexibility in the financing. Because even us, we've had some convertible note partners, and we needed some extra time to make good on the convertible notes without killing the business. Like we said, okay, we could pay you, but then you might not get 100% of what you're owed.
Yeah. Then you're done. Yeah. You're getting it at this.
So having the right partners who are understanding is important.
So is that part of what you're doing at HIP? Is do you take that side of it as well? Do you advise those who are looking and have a model that you would say, okay, look, this is a good investment over here? Do you assist in any way?
We have done that along the way. That's not our core business, but it's something that we do. What the closer thing to what we do today is either a founder wanting to know the sustainability of their whole business. So there's an organization called Farmland LP, so farmlandlp.com. And so Craig Wickner there, he's super smart biologist, agrologist. And he was like, hey, we're doing some cool things here. Can you analyze what we're doing? And so we did. And it turned out that he had like one of the highest corporate ratings we ever did for an operating business with, some gaps too. And so they, they published that on their website. They're like, hey, look at our score. Look at our 16-page report. Look what we're doing on the Sustainable Development Goals. They did a lot of things with soil and soil quality because they take pre-organic farmland and convert it to organic farmland, for example. So we do that, and then there's some private companies who have, private investors that want to know the sustainability profile. So what we have is obviously this model of how human impact can connect to profit, and we have this public company database of 14,000 companies. So if you tell us who you want to be like, we'll show you how close or how far you might be from that peer company. So we do that.
Oh, so you do a lot of people can get benchmarking information from you, because that's fantastic. Yeah. That could be very, very useful, obviously, utilizing that.
Yeah, and it helps. One of the funny stories out of that was we're doing that with a tech company, sort of this tech company doing something new in real estate. And one of the, as we talked about early on, one of the metrics is CEO pay. And so, and one of the metrics is employee pay. So, they wanted to be benchmarked to Salesforce. So we showed them what the employee pay differential was to Salesforce average. And the employees were like, hey, we should be getting more. And then, of course, the CEO was getting paid almost nothing. And he was like, well, I'm getting paid almost nothing, so I'm behind too. So it was a sort of a delicate conversation to have, but it helped raise the vocabulary and scorecard metrics of sustainability that led to, that can lead to profitability. So it's a great sort of unifying event. It's a way to have an honest view. It's a way to have peer benchmarking. And then, then you can use that as part of your, investor capital raise or the like.
Yeah, I imagine people find things they didn't really think they wanted to find.
Or don't want to highlight, but it's a comprehensive framework. So part of the, in tech or in farmland, there are gender gaps. So they're like, okay, we'll set a goal for 3 years to close some of these gaps. So it's not bastardizable. You mentioned are there systems that are bastardized? Ours is real data in a real model to model the real world.
I just like to say the word bastardized.
Yeah. So it's people ask us, how do I improve your score? It's improve these metrics. That's how.
Yeah, here you go. I just showed you the metrics. Here's how you do it. See this one that's a 40. Get that to a 60. You're better.
Exactly.
You have improved. Exactly. So let me ask you about the political climates and sustainability, right? I mean, you've got people, and everybody. I've got haters, and that just proves to me I've made it to some level of impact. When I got my, I was like, yeah, I told my wife, hey, I got my first hater. Yeah. But those that are sustained, it's a scam. It's a way to get money and blah blah blah. And there's certainly situations that are out there. There's some certifications out there that in my mind are a little bit suspect, just because there's back in the 80s and early 90s at a former company trying to achieve the Malcolm Baldrige Award and that type of stuff. And there were certain things, I think better than half the companies that won the award went out of business with
Malcolm Baldrige Quality Award.
That's exactly. Yeah, that's exact. Yeah, the quality award. Yeah, it was not necessarily. It was it was almost like the Heisman curse. You know what I mean? It was.
But that curse is everywhere. Only 2/3 of all mergers and acquisitions work. So even without an award, 2/3 fail because people, don't follow through, or things change over time. But
they do.
Yeah. So what did you want to say about Malcolm Baldrige?
What? Nothing really. It was kind of a side story as to where I'm going here. Is there are specific there are people out there that argue against the sustainability certification, and will still argue even after hearing what we're talking about here, that we're wrong and you're wrong, and those companies that profess to be sustainable and go after this are not the best investments. And there's even specific public policy against public funds investing in specific companies. Texas would be one of them.
Yep.
Right?
Yep. All right. So, well, let's jump in the water.
So that's a big ocean to jump in, but let's jump in there a little bit, right? Okay. I mean, what is that there? Because I see reports that say, look, you're not allowed to do this. And then, by implementing that law, it costs the taxpayers hundreds of millions of dollars. And by not allowing this,
right,
So where's the outrage? Where are people going, whoa, whoa, whoa? How do
This
you
is a
promote
really
that?
interesting thing about the culture today. Well, there is outrage. Outrage exists. And then there's, laissez-faire behavior exists, like freedom
Sure.
at any cost, freedom, woohoo,
Yeah,
right?
yeah. Freedom or die.
And then there's apathy. So the mix of freedom, outrage, and apathy. I mean, so those are like three bubbles. Um, let's talk about Texas, and then we'll talk about possible ways to fix it. So um, in Texas, there was the ice storm, if you remember, 2 years ago,
Oh, yeah. Very, very clearly.
and the ice storm knocked out power plants and the grid. Now, I mentioned before my first 2.5 years of my career were in the McKinsey energy practice, so I can tell you what all of the grids are in the United States. I can tell you what all the nuclear power plants are in the United States. I can tell you the cost structure. I can tell you the deferred taxes. Um, Texas is on its own grid. So whereas the East Coast has multiple grids, and sometimes the grids can sell power to each other, Texas is its own thing, right? Texas even had, as a point of history, its own embassy in Paris in 1850. So there's a
Well,
so
we all know the Texans' ego.
so how did that happen? It happened through deregulation. And, if you remember Enron from 2001, where
Hmm.
Enron choked California Power and the governor was slow to cut that off. Well, what happened in Texas is the variable pricing spiked, and some low income people got electricity bills of $20,000 or $30,000 because the incremental price of power was $1,000 a kilowatt hour at that, during that. Okay, so that's the environment of Texas, and the environment of Texas is the city of Austin will pass progressive policies, and then immediately the state of Texas will pass a law to override the city policies.
Right. Yeah, that is Texas for
All
sure.
right. So here's the latest thing. Texas has an actual law, and we know because we've gotten a telegram from Texas that we had to reply to within 61 days.
A telegram.
FedEx. They paid for a FedEx.
They did. It didn't come Pony Express or anything like
No.
that. Okay.
The law in Texas is there shall be no interference with the commercial interests of oil, gas, coal, and fossil fuel. No interference from anybody on oil, gas, or coal. So first of all, I'm not sure that's a legal law. Nobody's
Well, wait a
contested
minute. Wait a
it.
minute. Isn't Tesla moving to Texas?
They've moved to Texas.
Yeah, I mean,
Klaus
yeah,
Schwab has moved to Texas.
they already have. So what?
Yeah.
Okay.
So there's
Except
no.
for these guys.
Well, we'll see what happens there.
Okay. Except for this.
So, okay. So, can you pass a law where business cannot be interfered for anything? Electric power, fossil
Yeah.
fuels, polluting the air, the Gulf of Mexico being filled up with oil for 65 days from the BP gusher, right? So, okay. So, this form of question says, please tell us the federal and state laws that you are following, and are you doing anything in excess of federal and state law? Well, at least till January 20th, 2025, the U.S. is part of a global treaty done in Paris that requires greenhouse gas reductions. So first of all, there's that. There's
So
federal
you're
laws
good.
for
You're good
greenhouse.
for another 4 days.
There's state laws in California, Massachusetts, Illinois, New York that have specific greenhouse gas reduction targets. So yeah, we're following the law. Well, they're going after Net Zero Alliance. They're going after fossil-free portfolios, which we offer. That's probably how they discovered us in Morningstar.com, because we operate fossil-free portfolios for 401ks as well as for investors. So if anybody wants a fossil-free 401k for their company, offerings, that's something we do. So they want to know what nonprofits we support committed to net zero and to greenhouse gas reduction, because that is interfering with the commercial interests of oil and gas companies in Texas. So we replied that we are following the law in these states and federally as a nation. We replied that all these factors, when you compare our HIP 100 strategy and our fossil-free HIP 100 strategy, the fossil-free HIP 1 strategy outperformed over this time frame. So it actually is better for investors to avoid fossil fuels and the risks and the financial risks, and to gain the financial returns over time. And that these are risks our clients care about. So if our clients have asked us for this, so we are serving our clients. So if you disagree with client service and you disagree with financial returns and you disagree with the federal and state law, then yeah, you're going to have a problem with us. But those aren't problems. We believe in real world physics and real world biology and real world chemistry. And carbon atoms last for 100 years, and the accumulation of those last, and they intensify storms and fires and hurricanes. And so now insurance companies, which are going to probably be the next brunt of this, not only healthcare insurance like we talked about, but home insurance and commercial insurance and real estate insurance, this is going to come to a head. And so Texas was one law that has passed, one state that's passed a crazy law. North Carolina is another state that has passed a crazy law. They have mandated that sea level rise can only be arithmetic. It cannot be geometric or exponential. So the North Carolina legislature has told Mother Nature that they can't rise sea levels very quickly. That is against the North Carolina state policy. So these are the challenges. So what's the solution? The solution is, I would like every CEO to go tell their mother and their father how they run their business. Here's how we run our business. We pay people the least that they'll work for. We turn over our employees as fast as they leave. We pollute the environment and don't pay for it. We battle every court case that comes to us because none of them have value, even though some of them does. Like if you would go down all the data-driven metrics that we have and explain that to your parents, most parents would disagree. They're like, smack you across the face. What are you doing? Why?
Yeah. What is your issue, man? Yeah.
And so that's the thing. These, the power of finance over impact, the short-term versus long-term, the how to treat everybody right along the way, and we all grow together. These are the things like the cultural and philosophical and moral principles. And so when you do something sustainable, it generally works because it's a good return on investment.
It is.
So one of the other coaching
Are they more scared about does it come, I'm sorry, I'm interrupting the hell out of you, but we're sitting here having a conversation. Don't lose your train of thought, please. But does it come from a fear of disruption instead of trying to be the leader in disrupting the industry that they're in? I mean, is that it? Are they fearful of the adoption of just complete banning fossil fuels willy-nilly and not having the concern of the social impact that would have? Because if you did that today, you would destroy a huge portion of our society. Right?
It's really funny.
Is that where the fear? Is that where the drive is? The fear of that type of thing.
Those are probably contributing factors. Exxon was one of the most biggest renewable energy investors in the 1970s.
Exactly. That's what I'm saying. Where did that go?
That disappeared in 1980 and 81. In 1980, Ronald Reagan was elected, and in 1981, oil hit $9 a barrel. And so when oil hit $9 a barrel, boom, all the renewable energy got shuffled off. When Ronald Reagan was elected, he ripped down the solar panels that Jimmy Carter had put on the White House. These are stupid things. Like, why would you not invest in future product roadmap? And two, why would you eliminate something that saved you energy? And from this old TV commercial, I don't know if anybody's old enough to remember it. I'm 56. There was this old TV commercial in 1970s. It's with this old lady. Oh, you're going to put in a wind turbine? Yeah, wind is free, And so wind is free. Solar energy is free. And the more we can make those solar panels and wind turbines efficient, the more they help. If you don't like
and solar energy is now cheaper than fossil fuel energy.
It is, and it's one of the biggest additions to energy capacity as well. Texas has humongous wind farms. So you want to ask, like, hey, what's going against the commercial interests of oil and gas? All the wind farms in West Texas go against the commercial interests of oil and gas.
Yeah, well, the oil and gas industry is probably using that energy to power the Permian Basin. So it's okay.
Yeah. So part of the problem, Michael, is I tell sustainability people if they're going to the CFO's office or the financial analyst's office, don't go in and say, hey, I have this great green project.
Yeah,
Go in
no,
and
that's not the
say,
right way to go.
I have this project that pays back in 6 months. Are you interested? 6 months? How many of those do you got? And so sustainability people need to, one, have financial vocabulary, know how to build a spreadsheet and a return on investment, calculate a payback. And so if you can have an attractive return on investment and positive, short, in the best case, short payback, but, some sort of payback language.
Yeah.
That will be listened to. I usually say sustainability people need to be ambassadors. What do ambassadors do? Ambassadors speak both languages, ambassadors know both cultures, and ambassadors find the bridge between the cultures and between the languages. And so when sustainability people bring return on investment language and payback language first, and then the finance people might not even ask what the details are. They're like, give me more of those. You may not even need to describe what it is. And so that's the, we've talked a lot about the politics of do people listen to each other or not. And so we just need to listen to each other and try and understand the drivers, and where possible, win people over on different levels of argument, some quantitative, some qualitative, some emotional, some visceral, some moral. But you need to have a conversation about it. So it's not fair when a finance person rejects green when they hear the word green, unless it refers to money. And it's not fair when a sustainability person has to get upset about it. But if we understand how decisions are being made, which is a lot financially, and we can show real success of real data on the real world, then we have our best chance of succeeding. So that's sort of how we approach it.
That is fantastic. And I can't think of a question that I could ask that would elicit that great of a wrap-up response on what your message would be to everybody. It was fantastic. It was fantastic, Paul. I absolutely loved it. I'm glad you came on the show. Hopefully I can have you on again sometime soon.
Happy to return. Happy to, dig in deeper on issues, generic or specific. We for the future, something we want to stimulate more of is what's called cross-sector partnerships. So business, working with government, working with nonprofits, cross-sector our problems are cross-sector, so our solutions are going to need to be cross-sector.
Yeah.
What people can do today is buy sustainable, work in a sustainable organization, vote for sustainable solutions, and invest sustainably. So whether it's your own portfolio or your 401k, or you're managing money for your kids or your parents, look to be more sustainable. That's the long-term positive trend. It generally reduces risk, and it generally can increase or meet typical returns. So HIP Investor is one place to do that, but put your money to work. Don't just put your time to work, put your money to work.
Yeah. I agree 100%. That is fantastic stuff. Anything else you want to add to this, Paul, before we say goodnight to the fine folks?
Yeah, just take action. Don't just talk. Take action.
Yeah, and you don't listen. And I think one of the things that I would, maybe you agree with this or not, but you don't have to chain yourself to the front of a bulldozer in order to elicit this change. In fact, I would argue that you're doing more harm to the sustainability movement and future of the planet and our society when you do take those type of actions to do it.
Two environmental entrepreneurs in Canada used to do that, and then we funded them at ashoka.org. They're like, yeah, we used to do that, and that doesn't help.
No, it doesn't do anything. It makes it worse. It paints that side as being these nut jobs that are detrimental to society and are detrimental to business and finance and that's not good. It's not good because it isn't. It is a sound economic growth pathway or design or engineered structure.
It is. And it takes longer to take sophisticated action, but you also need to think about the consequences of taking easy action. And
instant gratification isn't good for anybody.
Easy negative action usually has bad consequences.
It usually does. I've experienced. I was a teenager at one time, and I did go to college. So yeah, I understand exactly what you're talking about. I understand it completely.
Yeah, my hair used to be black, so.
I love it, brother. Where are people going to learn more about HIP? hip? Is it hip.com, hipinvestor.com?
Yeah, come to hipinvestor.com, hipinvestor.com, hipinvestor.com. We've been writing and publishing for 19 years, so you'll find something in
You'll
the
find something.
search
Yeah.
engine. We have the 2 books, the Hip Investor book published by Wiley, now 15-year anniversary on Earth Day.
Oh, fantastic.
And the
Great.
global handbook of impact investing, which is like the PhD of impact investing, and that's published by Wiley as well, with 50 authors and 30 chapters. And then I'm on LinkedIn, and so come have a conversation on LinkedIn. And
Yeah, LinkedIn. Look up R. Paul Herman.
yeah, there may not be a dot.
Yeah.
There. R. Paul H. Yeah.
Oh, it is R. Paul H. But I mean, yeah, yeah, exactly.
Or R. Paul Herman, right?
Yeah. Either one is going to work. That's how I found you. Well, no, it's not true. We were introduced.
Yeah. Thanks to Laura. Agiela.
Laura is fantastic. I love her. I've had her on once. I got to have her on again.
Super.
Because she is fantastic. Anyways, it's been a pleasure meeting and talking with you, Paul, and I hope to do it in the future. Check him out, everybody. Look him up. Go to those places. And, hey, peace and love, everybody.
Please send the temporary tattoo for Sustainiacs.
There you go. You got it.
Hey.